Hey, what is up, everybody? What is up? Welcome to our live show. Welcome to the Power Up Real Estate Show, where I'm talking today about something that needs to be addressed. You need to know about. You need to know what's happening right now because the Feds just hiked the interest rate again, and they hiked it 0.5 point. The Feds hiked the interest rate once again. But one of the things when we talk about inflation and interest rates rising and things changing in the housing market, we have to understand we're only talking about this to equip you to be response ready. It's to equip you to be response ready, because if you're not response ready, meaning you don't know what to do. So what? So the Feds hiked the rate. What does that even mean? What does that change for you and your money? So we're prepping here and we're making sure that everybody is ready to go. So we're going to be talking today about the Feds raising the interest rates. And we are here live on YouTube. We're here live on Facebook. We're live all over talking about these hikes in the interest rates and what that actually means for you, So make sure that you hit that like button, subscribe to the channel so that you understand what we're talking about today. And you also make sure this gets it out to more people. So the Feds hiked the rate. The Feds hiked the rate 50 basis points or 0.5 point, meaning what that means is it is about 0.5%, and it's going to continue to spike interest rates for you and your family if you want to buy a home. Right now, just about this month, just last month, at the beginning of the month, we hit about 5.5% interest on most homes. And that is highest as it's been since 2009. But the kicker to this 0.5 point raise by the government and the Feds is this is the biggest spike since 2000. This is the biggest spike in 2 decades. Now, understanding, once again, we talk a lot about the mechanics of the economy, what actually makes an economy run and what makes an economy struggle. And when the Feds hike the rate like this, what are they trying to do? There's a couple things that they're trying to do. Number one, they're trying to slow down economic growth so that they can slow down inflation. So they're trying to kind of curb the flooding of the market. They're kind of trying to hold that back so that things don't inflate so much. Because one of the things that allows inflation to run rampant is demand. When everybody's trying to buy the same thing and there's 400 person trying to buy the same piece of lumber, drives up the price. But if that piece of lumber is no longer $6, it's 12, the 100 people trying to buy that piece of lumber go down to 20 or 5. And what it does is it slows down people. It slows down the race towards product. It slows down the race towards product and service, and therefore it hedges the inflation. It hedges inflation a little bit. CNBC put out a couple I think some good data just showing a little bit. The average interest rate for the 30-year fixed mortgage hit 5.5%. And again, this article was just posted yesterday after the Feds hiked the rate. Which is the highest since 2009, and it went up 2 full percentage points since December, which was about 3.1. That's a big spike in a short period of time. However, a lot, and I mean a lot, of the economic gurus are saying this had to happen. We had to have this happen in order to make sure that we don't run crazy with inflation. Seeing interest rates go up. I did a video a couple weeks ago on the 4 benefits of rising interest rates. Make sure you watch that video on the channel. It was another live video we did helping you understand rising interest rates aren't the enemy. It's not the enemy, and it's not nearly as oh my gosh as you think it is. Interest rates, when they go up, it certainly changes the mechanics of how we buy, what we buy, when we buy, how much we buy, if we buy even sometimes. But when the if we buy comes in, when the rates go high enough where it changes if we buy, then the economy takes a hit. But remember in 08, 09, the crash wasn't, especially in real estate, it wasn't necessarily, which was a economic turmoil throughout the country. It wasn't because of inflation, and it wasn't because of higher interest rates. It was because of a surge of foreclosures due to some unsmart lending, right? And then the Feds lowered the rate in 2010. They really just dropped it after 08, 09. So you have to understand the low rates we're seeing right now, we've been feeling even before COVID came in. The low rates we've been feeling for the last decade since 08, 09 has been because of the crash. The Feds lowered the rate to stimulate buying. So in a crash, they lower the rate to stimulate buying. In massive inflation, they raise it to hedge buying so that they can hedge that inflation. And a lot of the gurus are saying the rates raising are one of the things that can hold our economy intact while inflation is going up and cars are up nearly 40%. And some data says even north of 40%. And so when we see the Feds hike that rate, what does that actually mean for you? We're going to talk about that in just a minute. But I want you to see the overlay of what's actually going on with the Feds hiking the rates and what that actually means. So the Fed Reserve's, again, they raised it a half a point or 50 basis points the other day. And the Federal Reserve is behind the curve, which is chief financial analyst at Bankrate. He said, the Feds are really behind the curve. We've been too low, loaning money out. And I know you and I going to the closing line and closing on a house. My wife and I bought our house in Phoenix at 2.87%. That's crazy. That's essentially free money. And we've gotten used to that. We love those low interest rates because it allows us to buy more. The problem with those low interest rates is it speeds up buying, speeds up inflation, and weakens the dollar. Because anytime you can borrow a dollar at 2.87%, that dollar ain't worth very much money. When you raise those interest rates, it makes that dollar harder to get. It makes it more sought after. It's more valuable. And so that's one of the things that we have to understand with these Feds hiking the rates. It's going to slow things down. It's going to, but that's the point. That's what they're seeking to do. Now, you may differentiate, your opinion may say, yeah, but if they slow it down and the real estate market crashes, that'll be a catastrophe. But I don't think that that's going to happen. Number one, we have so much demand right now in the marketplace. I don't think we would have to have a surge of supply that would even cross 2008, 2009. And the other thing that is different now with the mechanics of 2008, 2009 to today is 2008 and 2009. We had a lot of people over leveraged on their home. Today, we have 37% of Americans that own a home, own the home outright. Because of 08, 09, people were able to buy homes so cheap and get them paid off over the last decade that we have a lot more people owning their home. This is one of the things that encouraged me during COVID when I saw so many jobs get lost and then a surge of needing of jobs. I saw that and I thought, man, what if all these foreclosures happen? Then I started diving into the data and realized a lot more people own their homes. So this spike of interest rates it's going to hurt new buyers. But even as Robert Schuller said in the Schuller report, he talks a lot about the interest rates and bank rates. And he says, a lot of times when the interest rates go up, it does not slow down buying. What it does is it changes the category with which somebody buys. So if somebody's looking for a $450,000 home, they may come down to a $350,000 home or a $400,000 home. They're going to drop the price to fit the monthly payment. And that's what most people go to buy is they go to buy a monthly payment. So again, McBride also says rising interest rates means borrowing is going to cost more, but it eventually means saving will earn more because the more money that you have, and again, is the strengthening of the dollar and that strengthening of the value when they make money harder to get, the money that you do have is worth more money. And that's one of the reasons. So this isn't a crazy response to what's going on. We knew this was coming as economists, as we study money and study what happens in the market. We knew this was coming. We didn't know when. When Biden took over in the new administration, as you know, on this channel, we never talk politics, and I'm not talking about sides, but when Biden came in and they talked about not doing this for a little bit longer period of time, but I don't think that they anticipated the speed at which things inflated. So they were saying we aren't going to raise rates for probably 2 years. That's what Biden said when they went into office. The problem is inflation took off so quickly that now we're in his second year. And so, maybe being in his second year means that's one of the reasons why we're seeing it come by now, right? And so, so maybe that's why it's starting to come in. But this second year, inflation took off like wildfire last year. And so they needed to do this. So now we kind of understand Feds are hiking the rates. Interest rates are going to continue to go up. What is that going to mean for you, your family, your money? How do you respond? So depending on which camp you follow, some camps will say in interest rates rising times, having cash on hand is king. I'm not going to say cash on hand is king. Now, having an emergency fund, and this is where Dave Ramsey and I are going to shake hands and agree, having a backup fund to back you up, I think is very valuable. and very, very important, because if anything happens, then you have a little bit of money so that you and your family are cool. And so I think having a backup fund is good. But I think right now what we need to do is we need to get our cash in cash producing assets and holding accounts, whether that's getting your cash from a savings account to a life insurance policy, that can make you anywhere from 3 to 5 rather than 0, or as I do, investing in apartment buildings, multifamily real estate, any real estate that returns money for your money. Because even if the market crashes, if you have cash flow from that property, and even if the interest rates go up, see, here's the kicker on the Feds raising the rates. When interest rates go up and you're invested in something that pays you month after month after month. So let's say you lock in at 6%, 7% even. Let's say it goes up there that high, which it certainly hasn't gone that high yet. Commercial still, around 5. And so, and even lower, some depending on what kind of programs you're getting. So let's say we're getting cash producing real estate that's paying us month after month after month. You've locked in at 5%. Let's say it goes to 7. You're still at 5. Doesn't matter. You're still at 5. So lock in and you're still at 5. Now, let's say it drops to 3. Refinance. Drop to 3. Refinance. So you can respond, but lock in on something that can give you a return on your investment. And if by God, unforeseen future, we see a true crash, which I don't really think that's going to happen. What a lot of people don't understand with crashes, 08, 09, only crash in my lifetime, and really the only real estate crash in the last 100-ish years, is that doesn't get to I think we're going to have a correction, not a crash. I'm actually going to shoot a video on that coming up, on the difference and how the mechanics of the difference, so you understand what that looks like. But again, based on what we're seeing this go up. So it's going to make it more important you put your money in cash producing assets, because if the market tanks and if everything crashes and real estate loses its value, then you're like, yeah, Mike, but then I hold on to something, real estate, that lost its value. What's the value in that? The value in real estate's a reverse gravity market. It's a reverse gravity market. Now, what that means is, historically, real estate goes up. If it goes down, great, then it goes up. And when I say great, I mean that facetiously. Okay, it goes down. We can't control that, but it always comes back up higher than where it was to begin with. 08, 09 crashed hard, but it came back to the strongest real estate time we've most likely ever seen. And so you see so much power in the real estate market, right? And so, but it was after a crash. So again, even if it does, but guess what you hold on to in that time? You hold on to your cash flow. So as Feds are hiking the rate, you want to respond by putting your money in things that produce cash. You want to produce cash. So the first thing is invest in producing cash producing assets. A lot of people will say investing in silver and gold because they're hard assets is great. And I think that's a great idea, investing in silver and gold. But again, I like cash producing assets that also appreciate in value, which is commercial real estate, which I love commercial real estate. The other thing you're going to want to do is you're going to want to knock out any high interest debt. And this is really consumer debt. This is any credit card debt, any lines of credit that are really high, this get back cash fast stuff, anything on your financial shoulders that's high dollar. We want to knock that debt out, because the interest rates of that is going to go up as well. When people loan, when the banks are loaning money at higher interest, that means businesses loan money at higher interest, which is credit cards, right? So again, they're going to loan that at you at a higher interest rate. So most likely, wherever your credit card is, it's going to go up over time. So you want to make sure you knock out consumer debt, knock that junk out, and don't get back into it. Get consumer debt off your shoulders. It is the choker of freedom, man. It just wraps around your neck and you just can't breathe. So get that debt off your shoulders and get it out of there. So let's get all the consumer debt off. Figure out a plan and get that junk off of your shoulders, because it's just going to keep choking you. It's going to keep choking you. The second thing is, I would be strategic about investing now, probably more than ever. So a portion of your income, my wife and I, every time we make money, we give 10% to the church. That's just God's money. We don't touch that. And then we give, we put a percentage of our money into what we call our wealth account, or an investing account. I first heard this principle from T. Harv Eker in his book, Secrets of the Millionaire Mind. But the whole point I learned about that is, oh, I should be paying myself first. I heard that term from Robert Kiyosaki, Warren Buffett, all these financial gurus over the years. I never knew what that meant. They didn't mean put money in and go spend it on anything. No, paying yourself first means you take a portion of your money every month and you invest it and you invest it and you invest it. And what I say to invest in is things that produce cash and appreciate. There's 4 reasons I invest in real estate, right? The cash, the appreciation, the depreciation, and the control. The control is why I invest in real estate, because I can control the value of it goes up. I can't control if stocks go up or down. That's out of my control. Real estate, I can control that a whole lot more. So be investing. So first, knock consumer debt out, get it out of that high interest debt. Let's get rid of it. Number 2, especially as interest rates go up, you got to get your money invested. As Warren Buffett says, in times of inflation, you want to invest in things that you can leverage inflation and not have to put more money in to do it. Whether that's businesses or real estate or whatever else, you can invest in real estate, take on some debt, and ride that wave of inflation in your income and never have your debt go up or your cost go up. So in times of raising interest rates, lock in as fast as possible and ride that income wave of inflation, right? So you want to invest in things where you can ride inflationary waves and not necessarily see the number of your debt or the amount of debt go up, etc. So crushing credit card debt, making sure you're investing is key. The second thing, or the third thing, is if you are going to buy a house, adjust. Make sure you're really careful. If you go in to buy that house and you were looking at $550,000 homes or wherever you're looking, if you're in the Midwest, you can certainly get one for better than that. But no matter where you're at looking, or if you're on the coast, you're much higher than that. But look at what you're buying and make sure it's manageable, right? Don't overextend yourself. Just because the bank says they can loan you that money, don't mean you should take that money, right? So you want to make sure as interest rates go up, you adjust your target. If your target's 550 and the interest rates just went from 5 to 5.5 or 5 to 5, 4 3/4 to 5.5, and now you've got that half a point or that 1.5 difference. Adjust your payment to make sure that you're still safe with what you're doing, right? So responding in debt, responding in investing, responding in buying, how we buy, and the fourth one is respond in income. Focusing on your income. Now, if you have a 9-to-5 job, there is nothing wrong with a 9-to-5. You're never going to hear me say kick your 9-to-5. I think 9-to-5s, if you love what you do, a 9-to-5 is a great blessing. It's guaranteed income. The downside or the con to a 9-to-5 is sometimes you can't control your income. So that's why we invest and we look at side hustles. We look at investing. We look at what we can do on the side in order to focus on increasing our income. So whether that is seeing how you can add more value to your job, ask for a raise, or start a side hustle that increases your income, increasing income is really, really, really important. So increasing income is another thing to be focusing on. So again, focus on high consumer debt, you focus on investing, you change your buying, and you focus on earning. Those are the 4 big things you focus on in a time that we're in. Because with Fed's hiking the rates, it's gonna impact the way you buy. The whole point is to impact the way you buy. That's why they're doing it. The whole point is to slow it down. Robert Schuller was asked recently, how do we get out of the country's debt? I mean, we got trillions to almost $30 trillion in debt. How do we get out of debt? Well, one of the most powerful ways to get out of debt is to inflate our way out of debt. You can inflate your way out of debt. And by inflating your way out of debt, and some people say, how do you inflate your way out of debt? Well, think about this. If I'm selling you a pair of shoes for $100 and that same pair of shoes is now $130, the government isn't taxing 100, they're taxing 130. They're getting more tax dollars. They can take that more tax dollars, and that can slow down the national debt and even bring it down if it's managed correctly. Right? So you have to understand it's not a fearful thing when Feds hike the rates. It's just we change strategy. Every single investor throughout history just changes strategy based on their time. In 2000, we weren't really talking about crypto. 2010 to now, we've been talking about it a little bit because the thing, spiked up and came down and all kinds of things. So a lot of people are changing their strategy and coming over to crypto or, you know, the whole syndication and apartment building kind of blew up over the last 2 to 3 decades. And, you know, now we're talking about that. And so again, make sure you're shifting your strategy. Focus on income, get rid of debt, focus on investing, shift your buying. Those are the 4 big ones that are going to change and make sure that you can hedge against whether the Fed's hike the rates or not, right? So if the Fed's hike the rates, you can't control that. And in many ways, I'm glad they are, because once again, if a dollar is easy to get, that means it's not worth much. When a dollar is harder to get and it costs more to get, it brings the strength and value of the dollar north. And I'm really, really, really glad they're doing that. And so now, yes, when I'm buying apartment buildings, it costs me a little bit more money, but I understand a strong economy makes me way more money than one deal where I got to pay 6% rather than 4% interest on a deal. And so, and yes, I might make a little bit less. My investors might make a little bit less on that deal, but we make way more in a strong economy than we do in an economy that's inflation's running crazy and it's cheap to get money because the dollar isn't very strong. And so again, I want you to look at the anything, the economy as a whole. And I want you to look at it from the perspective of strategy, not from the perspective of fear. The perspective of fear looks at the economy and says, what if, man, what if? The perspective of strategy and opportunity looks at it and says, where's the opportunity right now? Every single economy has an opportunity. Every economy has an opportunity, right? Even the gold rush, it says, who made money during the gold rush? The people selling the shovels, right? Somebody said, oh, people are coming out here to dig for gold. Let's sell them shovels. Again, look in every opportunity, every economy for where's the opportunity. And right now the opportunity is in cash, producing. Real estate is a big one. Businesses is probably the biggest one for cash flow, because there's a lot of business owners retiring without a succession plan right now. So continue to place your money into things that will grow for you, but you got to also focus on making more of that money so that you can have more to invest and have more to manage. And then again, making sure you're changing your buying patterns and canceling out that high interest rate. We've all been there, right? My wife and I were there, had a bunch of high interest debt years ago, and it just chokes you. You got to get that out. So Feds raise the rates. What do? Get rid of debt, focus on earning, change your buying pattern, and make sure that you are investing a portion of your income in cash producing hard assets, preferably that you can leverage debt, because leveraging debt, you can ride that wave of inflation and not crash. Love you all. Have a great day. I'll see you in our next video.